Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Britta von Oesen. She's a partner and managing director at CRC-IB, as well as Dave Cherney, clean energy policy lead at PA Consulting. We're here to discuss why demand for clean energy remains strong. We'll also talk about financing and the M&A outlook. It is great to have the both of you with us. Welcome to Trade Talks. Britta, let's kick it off with you and get an overview of the current state of the renewable energy market. Where are you seeing that demand coming from?
Yeah, hi Jill. Thanks for having me. So renewable energy remains an incredibly strong industry at the moment. We have had several curveballs thrown at us over the last couple of years, whether that's supply chain issues, changes in financing, policy risk, all of these different components, and yet the demand continues to be incredibly strong for renewable energy. Investors continue to be incredibly bullish on the prospects of investing into the space. And we expect to continue to see that over the next couple of years. A number of drivers for that, including corporate demand and really just energy demand as far as what needs to be built in the next few years to support kind of the ever-growing data centers and AI infrastructure that's coming.
Yeah. And Dave, I'd like to get your thoughts on, we have a new administration coming in, and of course, there's been conversations around potential shifts in energy and clean tech priorities. Is it time to worry about that, or we really won't know until the new administration is, or will it have an impact at all? How do you think this could look over the next 6 to 12 months?
Yeah, it's a really good question. And certainly the new administration will have an impact. I think there's a lot of speculation going on right now. And the reality, right, is no one quite knows how things are going to shake out on January 20th and the next 100 days. That being said, I couldn't agree more with Britta. The underlying fundamentals of the U.S. power market, particularly related to clean energy and renewables, remains quite strong. And right, we can even go back to looking at the Trump 45 administration. So going 4 years, 6 years back, what we effectively saw, right, was some movement at the federal level that put a little bit of headwinds in renewable development. But at the same time, we saw a response from the states. And so there were about 15 different states across the U.S., from the west to the east coast: California, New Jersey, New York, Illinois, Colorado, Nevada, New Mexico, and more, that all expanded their renewable portfolio standards, their clean energy targets, thinking about offshore wind procurements in that 2017, 18, 19 timeframe. And what we've seen due to that is really an explosion of policy-driven renewable demand through the Biden administration. It's going to continue through the current administration. More broadly, right, the corporate demand that Britta talked about remains very strong. We've seen that with, for example, the announcements by Google and Microsoft over the last several days. And so really, yes, there's some uncertainty coming up in the next several months, but the underlying fundamentals of the industry are incredibly robust.
Yeah, I would agree with you. And I'd probably even take the other side on that. This administration, based on what they've been saying going in and what we saw at the first term with President Trump, is he really benchmarks his performance based on what's happening in the economy, the side, and being a global leader in everything he puts his footprint on. So there could be a motivation from that perspective to be the leadership in these new world, thinking about how he's placing people in positions to lead our efforts in AI. Maybe that'll transcend over to this because it is a newer technology. So you can't put a silver lining to it if you think of it in those terms. But Britta, when we think about the positive trends that we see right now, what about M&A and some of the financing that you're seeing taking place?
Yeah, well, it's important to note that these policy risks are nothing new for this industry. We've had sunsetting credits, we've had changes in administration, we've had ever-changing state policies for as long as we've been involved in this space in the U.S. So, financing continues to be incredibly strong. We are seeing new products come to the market, private credit, flooding the market, various new structures to kind of take advantage of what policy is today and building in some, safety nets as far as changing policy. So projects are getting built. Everyone is full steam ahead as far as kind of moving these projects forward and getting them financed. And so while there is, some concern as far as policy change, and that's always the case, that is something we are used to and something that we can structure around. M&A continues to be relatively strong on the project side. I think we are seeing a huge uptick in asset sales and portfolio sales. I do believe that corporate M&A, which we expected to come back extremely strong in 2025, may take a little bit longer to see how some of these policies kind of come to fruition and what that looks like. The demand from investors is there. The biggest concern is kind of bid-ask spread as far as what sellers are looking for their purchase prices. But certainly investor confidence and investor interest is there.
Yeah. Well, and Dave, that's a great point that Britta brings up, because we've seen the demand over the past 12 to 18 months. There's a trajectory there in terms of investors looking for alternative investments, and private credit is definitely an area that we've seen that growth. So that kind of also provides another tailwind. Are there specific regions or projects investors are focused on?
Yeah, and maybe building off a bit too of Britta's point of the bid-ask spreads that we've seen really over the last, let's call it 12 to 18 months, which has been constant both in renewable and I think on the thermal side of the power generation business in the US. Really, compared to where we were, let's call it 8-10 years ago, we have a number of power markets in the US that are exceptionally tight, right? So California, we can think about PJM. PJM is a 13-state market, the largest wholesale market in the US, and the list goes on. And what we're seeing is significant increases in both energy prices, but really capacity prices or resource adequacy in the case of California. And those fundamentals, right, the tightening of markets is likely gonna continue. Some of that is data center AI driven. Some of it is overall expected GDP growth. Some of it is different folks migrating to different parts of the US, and those underlying fundamentals, we're just in this incredibly tight environment. And so what I think we're seeing is certain investors taking a very bullish view about the assets that they own, particularly those that are physically in the ground today and well positioned to capitalize on this increased demand and really limited supply that's coming into the market due to challenges associated with interconnection queues, thinking about supply chain disruptions with some of the global instability we've seen over the last 2 years. And so when I think about it in whole, in total, it's these tightening markets that the demand's going to be there for renewable energy and for other technologies, perhaps more conventional as well, right? We're not going to let the lights go out in New York City, for example, right? Something needs to be there to generate that power.
Certainly. So Dave, when you talk about existing assets, those tend to be the assets that are more capital intensive and take, a number of years, built, put online, those that you're talking about.
I apologize. I couldn't hear the question there.
Oh, I'm sorry. So when you talk about existing assets, and that's where the demand is, that's where they're capital intensive, they take time to build, permitting takes a while. Those are the assets that are already in place that you're referring to.
Exactly. The assets that are already in place. It's the iron that's already in the ground. It's the assets that folks already own and are generating electricity today. We're seeing the intrinsic value of those assets increase. We're seeing the owners of those generation assets that are already generating electrons really asking for significant value associated with them, in some ways much more so than even 5 years ago. We're seeing the price of some of those assets effectively double over the last 5 years, which is really tremendous.
It's interesting, Britta. I wonder if part of that is investors, as they're thinking about deploying capital, perhaps don't want to tie some of it up 5 to 10 years, why that the existing assets hold some value. Is that the case, number one? Number two, are you seeing any demand in perhaps newer emerging technologies within the space?
Yeah, so on the first point, couldn't agree with Dave more. I think the operating assets and assets that are already in the ground are a place that a lot of investors are trying to deploy their capital, and the competition on the buy side for those assets is pretty significant. And we're seeing a very large uptick in the number of M&A deals of operating assets as a result. The new technology is also extremely interesting. So things like carbon capture, RNG, hydrogen. There are a lot of investors that are very excited about that and are deploying capital across the capital stack, whether it's on the tax credit side, interesting debt options, or on the equity side as well. So that is a huge demand for investor capital, and we're seeing pretty competitive markets on those newer technologies as well.
Adding on Britta's point there, I think we're also seeing a significant amount of enthusiasm with advanced nuclear as well. I mean, so certainly we have the existing nuclear, right, or bringing back things like 3 Mile Island, but the amount of interest on both sides of the aisle too, when we were thinking about the policy and political discussion a moment ago, there's a lot of enthusiasm for these types of technologies as a base load resource that is low carbon intensity to help decarbonize the grid over the long run.
Yeah, and Dave, actually, that's a perfect segue into the question that I was. What's interesting about this space is it's not like there's one particular technology. For example, when we think about AI, there's a handful of companies that have the chips that are needed to foster that demand. However, there are a number that go into the clean energy space. So investors have the opportunity to kind of pick and choose boxes as well.
That's right. There's an incredible array of technologies. I mean, certainly, right, we can go back to more traditional technologies in terms of natural gas generation, and we're certainly seeing advancements and potential movement with some, I don't want to call them newer turbines, but sort of redeploying existing technologies like the TM2500. So essentially a turbine in a truck, right? So this is a solution that California used for reliability in the near term here, where they've built essentially some temporary natural gas resources that eventually will move out of the market to help them achieve their clean energy ambitions. But then we have, of course, solar, wind. We can think about hydroelectric power, nuclear. We can think about advanced sort of pumped hydro, carbon capture. There's a whole range of technologies that are commercially being deployed today, and certainly a whole bunch of emerging technologies that are really interesting to see, and some really interesting prototypes coming out over the last several years.
What about innovations in financing and how these deals were constructed?
Yeah, well, it's been incredibly exciting in 2024. We've had some of the breakthrough financing transactions on new structures, which are very interesting and certainly kind of expands the opportunity set for everyone. So we've had some of the first carbon capture, tax credit financing deals completed. There's been a huge shift in debt financing, particularly in the distributed generation side, pioneering some kind of broad warehouses where you're establishing broad financing platforms for multi-year platforms to be able to just kind of funnel their assets into these financing structures and remove a lot of the kind of tension and administrative burden from trying to deploy more of these assets. So we're seeing just a ton of creative innovation amongst financing parties, amongst newer investors, and amongst our clients who are all structuring these facilities to really make sure that we're deploying a large amount of megawatts over the next several years.
Yeah, and Dave, I'll ask you the same question as well. If you expect this trend of innovation in financing outside of energy, but just in general, to continue.
Yeah, absolutely. I mean, I couldn't agree more with what Britta just outlined. So in terms of innovation, both in terms of financing and the way that technologies are being deployed, there's some really interesting examples out there today. And with at least in our client base, we're seeing folks, not just think about single technologies, but also hybridizing assets. So certainly there's examples like in California of essentially adding a battery on the front of a combustion turbine to essentially help with the clean energy transition, yet provide really fuel secure, dispatchable generation to ensure that the grid maintains reliability. We're seeing the same types of things actually occur in markets out east, where solar is being paired with combustion turbines as well through the same interconnect to allow clean energy to be the priority, but really help with grid reliability. So I think there's going to be interesting financing structures. I think there's going to be interesting pairings of technologies as well that we haven't seen over the last decade.
All right. Certainly an exciting time to be in the space. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.
Thanks, Jeff.